Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look at some of the key earnings for the week ahead. All of them really that I want to highlight here take place on the same day, Wednesday, the 22nd of May. And certainly this comes at the back end of earnings season. We've seen over 90% of the S&P 500 having reported already. So things likely to die down a little bit from here on in. But that doesn't necessarily mean it's over. And certainly the first company I want to highlight really does bring that theme home to roost because of the fact that it is the big hitter, the last of the Magnificent Seven, and the big leader of this tech rally over recent years. That is Nvidia. We have, of course, got to keep a close eye out on Nvidia earnings just because of the fact that they are essentially the poster child of the AI revolution. And if we continue to see rapid growth for Nvidia, it means that we're still seeing massive investment from some of the big tech in particular, which is something we know we have been seeing. And there is a view that that is going to continue to drive expectations of AI gains down the line. In terms of the forecast, what we can see here is there's an expectation that that growth rate is going to peter out. If you look at the earnings per share on the top end of this view, you know, what have we seen here? Well, we saw from Q1 of 2023, which is 109 in terms of earnings per share, up to 270, 402, 516. Then you look further out and you look over the course of 2024, that turns into 558, 593, 647, 694. So that growth rate is not necessarily anticipated to continue to play out in the way that it has in 2023. And I think that is going to be potentially a shock to some because they just think that you're going to see exponential growth. But for many, and, you know, I highlighted it at the beginning of this earnings season as my sort of preview for the entire piece, you know, many will be aware of that being the theme for this year, that growth rate associated with AI. It isn't necessarily expected to be maintained. We're expecting to see that ease somewhat. And as the economy picks up and we see central banks starting to cut interest rates, we're expecting to see growth rate elsewhere in the market and within the sort of equity space really start to gather momentum. So this time around, what we're expecting, 558 up from 516. So still growing at a healthy clip. 2451 expected on the revenue side of things. That's up from 22.10 billion. So certainly improvement, but this year is a step change from what happened last year, and quite how we're expecting markets to address that remains to be seen. You know, are people going to think, okay, it's fine, you know, we knew that was going to happen, or are people going to be shocked by that? Well, in terms of this company's share price, what we have seen is significant jitters of late. Now, let's just get it onto a sort of closer picture here. So what we can see here is we saw this significant pullback in line with the market, right? So let's see the NASDAQ. Let's grab one of these. Let's actually get it on a new price scale. There we go. So you can see that by and large, this is tracking the NASDAQ. It's one of the big components within the sort of tech sector, and that is to be expected. But so that weakness that we've been seeing in terms of equity markets really playing out for this stock in particular. And this is the kind of company that's likely to be highly sensitive to the expectations around interest rates. If I was to overlay the US 10-year yield, which is a good proxy for expectations for interest rates, let's see how that plays out. So this is notable. What we have seen here recently is this pullback, which is giving greater hope for the Federal Reserve to cut interest rates soon. And that provides upside for this stock. So if we were to invert this, then you can see that more recently we're seeing this playing out very closely as we see those yields coming down and expectations around a potential rate cut from the Federal Reserve coming into focus. So we've seen this company gaining traction. Again, look, we've seen this significant pullback. We've bottomed out from that. We've got, if we look on the 4-hour chart, this exit from this sort of descending pattern of lower highs and lower lows. The exit came with the breakthrough 907. Once we saw that breaking, we can now see, well, look, we've seen this very reliable trend of higher lows, higher highs. The pullbacks at the beginning taking the shape of relatively deep retracements. If I was to get that on here, so here's the first one. So you're seeing, there you go. So 61.8 on the first one. The second one, we're seeing it's like a 76.4, just about, yeah, so just above the 76.4. So once again, within that deep zone. What happens the third time around? Well, once we'd seen that break up through that swing high, you can see market confidence really appears to be different this time around. The pullback, very minimal, 38.2 on that Fibonacci retracement. Market sentiment, very different this time around. And we can see here the rally takes us within reach of that record high. You can see the prior record high we have established up here at 974. That isn't necessarily so far away, and certainly depending on market sentiment lead up to these earnings, we could see it broken before that. But I think that if we do see this slowing in terms of earnings and revenue growth, it could take some off guard, and certainly the expectations of the company and the forecast will also be absolutely key within that. So keep a close eye out for this stock, because whilst it has been a sort of poster child of the AI revolution, everyone thinks that it's going to be seeing such massive growth that it's the go-to place if you want to invest in AI. The problem is that we have potentially seen that the biggest area of growth in terms of percentages on quarterly or annual basis, and now things are going to normalize somewhat. That's not necessarily a bad thing, because if we see what happened over the past year, we saw this rapid run up for this stock, but ultimately it could fall back into being another one of the Magnificent Seven, where we don't necessarily see these same kind of growth rates for the likes of Amazon and Google and Facebook, Meta, because they're more mature in terms of that growth trajectory. We've just seen this massive boost, and now it feels like things are going to normalize somewhat. So watch out for potential volatility if we do see them striking a little bit more of a not downbeat tone, but trying to really temper market expectations. The next company I wanted to cover is Target. Now, Target is a kind of a discount retailer over in the US. Essentially, it's a high street name, and their ability to really corner that discount market is key at the moment, because people are very price sensitive, and that has been a key part on trying to drive revenue. Because you can see in particular earnings per share really managing to outperform quite heavily of late. The past few earnings releases have seen massive outperformance on earnings per share, less so in terms of revenues. And certainly if we're looking at, say, price action, what we can see here is that ultimately we've seen the past two occasions really respecting it very well. If you're looking at, say, let's just zoom out and try and get, I think it's on the daily time frame. There you go. So you can see where the earnings are. And you can see we're coming up to earnings here. But the last time around, we saw this massive jump back for the Q4 earnings. Then we saw it once again here in November. So the past two occasions, we've seen very substantial upside moves for this stock. I would warn, though, that we are, from a sort of technical standpoint, really rolling over in a meaningful manner from this key resistance zone 180 up to 183. You can see that, if we're looking at price action in terms of the S&P 500, we haven't necessarily followed the wider market of late, which has been recovering. Well, that hasn't necessarily happened here. And you can see here tracking that wider market move. But whilst the S&P 500 moves higher, the price for Target has been rolling over once again. So certainly sentiment at the moment, not necessarily in a great place. Will we see these earnings really turn the tide on that? Well, that could be the case. And if you look at the past two occasions, we've seen these big gaps higher. I'd say a breakup through 165.65 gives us greater confidence that we have bottomed out. But then, of course, the caveat here is that we're again targeting this sort of 180, 183 zone, which time and time again has stifled this share price. So look, we've just seen retail sales. They've come in relatively weak. We've seen jobs numbers recently that have been less encouraging. So there's some question marks around the US economy. I think from an inflation standpoint, we still have plenty of trouble ahead in my mind, despite the fact that we've seen inflation tick lower this week just gone. That doesn't necessarily mean that the Federal Reserve has reached its 2% target. And I personally don't even know that they're going to hit it this year. So if we do see sentiment shifting around that, I think this is the kind of stock that could be hindered, because of course, if we see the economy weakening and we see interest rates having to be held higher for longer, then it doesn't necessarily benefit stocks like this, which really want the US consumer to remain strong. And so recent signs of weakness of the sort of jobs market, consumers in the US, don't necessarily do favors for Target. So a key one to keep an eye out for, but certainly this recent reversal from that 180 to 183 resistance zone has played out despite the market rally that we've been seeing on that S&P overlay. We haven't seen that playing out for Target. So that does point towards a relatively downbeat assessment for this company as we head into its earnings on Wednesday. And then finally, I wanted to bring up another tech name, which is Snowflake, essentially a data warehousing company. They count the likes of Google, the likes of Amazon as their clients. And this is a really interesting one, because if you're looking at the trajectory of growth recently, it's been incredible. And the fact of the matter is that markets are expecting something similar to last month in terms of expectations. But look at what we've seen on the top end, right? 14, 15s, 22, 25, 35. And what were expectations? 4, 8, 10, 16, 18. We continue to see markets expecting very little, but the company really managing to outperform on the earnings in particular. Things relatively well aligned, but still beating on the revenue side of things. But really, the company has been ramping up earnings in a dramatic manner. The hope is that we see it once again, and we see further outperformance for this company. You know, this is the kind of company that I like to look at for earnings, because you look for a company that manages to guide markets in one way and then outperform massively, and markets then manage to see significant responses off the back of that. Now, what's key for this stock is that we have come into a really interesting zone of support. This is the weekly time frame. You can see this big collapse that we saw at the back end of the last quarter. But you can see here, in terms of price action over recent years, this stock has really been relatively downbeat. You can see here, though, that we've come into this trendline support. And so whether you're looking to say, okay, we're going to rally all the way up to those 2021 peaks or not, you know, that's kind of beside the point. What we're looking at here is a company that has seen really dramatic selling pressure. We've seen a company that typically does do well in terms of managing to beat expectations in terms of earnings. And then if you look at the daily time frame, you can see I've drawn it on here. We've got this inverse head and shoulders formation. I'm going to remove it now just so that you can see price action very clearly here. So that rally up from trendline support coming into earnings, the break up through that 164 level essentially coming into play here. We've got to the downside, these near-term swing lows are sort of 154, 155. As long as we remain above that level, then this stock looks to me like the kind of thing that's bottoming out. And given the sharp declines that we saw last time around, could we see this earnings report providing the basis for a strong recovery play? Potentially. So keep a close eye out on Snowflake earnings coming into this earnings report. We have got a stock that has been heavily beaten down and showing signs of bottoming out with that inverse head and shoulders formation, which to me makes it a key stock to watch as we head into one of the sort of final key weeks of earnings season.